All right, today we're cracking open a new investment case file. The subject, software giant Autodesk. And we're going to put this company under a very specific microscope. We're looking at it through the lens of legendary investor Warren Buffett. Let's get into it.
So first off, who is Autodesk? Well, you've definitely seen their work, even if you didn't know it. If you've ever watched a skyscraper go up, seen a new car design, or been blown away by a movie's special effects, chances are Autodesk was involved. Their software, stuff like AutoCAD and Revit, is basically the digital toolkit for the people who build and design our modern world. They are, and this is no exaggeration, the undisputed industry standard.
And that brings us to the central mystery of our case file. On paper, Autodesk looks like a slam dunk. It's a dominant, essential company. So why would an investor like Warren Buffett, arguably the greatest of all time, almost certainly take a pass on this? That's the question we're here to answer.
Our investigation starts with the most obvious clue, the quality of the business itself. And let me tell you, on this point, Autodesk looks like an absolute fortress. We're talking about what investors call a moat, a massive, durable, competitive advantage that keeps rivals at bay.
Think about how these four things create this incredible fortress. First, the switching costs are just insane. Can you imagine trying to retrain an entire architecture firm on brand new software? And converting decades of old project files? It's a total nightmare. That pain creates powerful network effects. Everybody from the architect to the engineer to the contractor has to use the same system to work together. Then you throw in a brand name that's basically a synonym for design and the power to raise prices that comes with it, and you've got a business that is just incredibly difficult to compete with.
And you know what? This fortress got even stronger. Over the last decade, Autodesk pulled off a genius move. They shifted from selling you a software box one time to a subscription model. Why was this so brilliant? Because suddenly they had this incredibly predictable recurring river of cash. The money just keeps flowing in, month after month, year after year. It makes the whole business rock solid. So far the case looks perfect, right?
But this is where our investigation takes a sharp turn, because even the most impenetrable fortress can be weakened from the inside. We have to look at the people running the show, and this is where we find our first real red flag.
You know, it's a bit of a Jekyll and Hyde situation. On one hand, management has made some really smart, sensible moves. They're buying up smaller companies that make sense, and they're trying to build one big, unified platform. That's good stuff. But on the other hand, you see some really questionable choices. They've been buying back their own stock like crazy, and they're often taking on a lot of debt to do it. And, maybe the most worrying thing, the company actually faced an SEC investigation over its accounting. Oof, that's a huge mark against trust.
So with some questions about leadership on the table, it's time to do what any good detective would do: follow the money. We're going to dig into the company's books now, and this is where we find a major plot twist. Because some of these numbers, well, they aren't quite what they seem.
Get a load of this. A 5-year average return on equity, or ROE, of around 350%. I mean, that is an absolutely astronomical number. On the surface, this number makes Autodesk look like one of the most profitable, most efficient companies on the entire planet. An absolute home run.
But here's the catch. It's not real. It's an accounting illusion. So how can such a stellar, amazing number be so misleading?
Well, it all goes back to those aggressive, debt-fueled share buybacks. This is a classic financial engineering trick you have to watch out for. By buying back so much of its own stock, the company basically made its own net worth, or equity, disappear from the balance sheet. And since that's the number you use to calculate ROE, the result gets inflated into the stratosphere. A much more honest metric, a truer picture, is return on invested capital, or ROIC. That number accounts for all the debt they took on, and it shows a company that's still very, very healthy and profitable, just nowhere near that crazy 350% illusion.
Now, despite that financial wizardry, let's be totally clear. This company is a cash-generating machine, and that's its real core strength. The actual cash left over after running the business, what we call free cash flow, has been growing like a weed. It's gone from $700 million in 2019 to over $1.3 billion in 2024. That cash is the lifeblood of the whole operation.
Okay, so we've got a fantastic business, some question marks around management, and some tricky financials. But for a value investor, for someone like Buffett, everything, and I mean everything, comes down to this final piece of evidence: the price you pay. This is the smoking gun that can make or break the whole case.
Let's just lay the numbers out on the table. Based on a deep dive into its cash flows, our best estimate for the intrinsic value of Autodesk, what it's really worth, is somewhere between $210 and $250 a share. But the market is currently selling shares for around $265. Do you see the problem here?
The problem is this number right here. Warren Buffett's most important rule, his cardinal rule, is to demand a margin of safety. You want to buy $1 for 60 cents, not $1 for $1. It protects you if you're wrong. But in this case, the margin of safety isn't just zero, it's negative. You'd be paying more than the business is estimated to be worth. For a value investor, that is the ultimate sin.
So with all the evidence in, a wonderful business, some questionable management decisions, and a very high price tag, it's time. Let's close this case file and deliver the final verdict.
The recommendation is actually pretty clear. If you already own Autodesk stock, hold on to it. You own a piece of a truly wonderful business. But maybe be cautious about adding more at this price. And for anyone thinking about buying in new, the verdict is to avoid it. The price is just too high to give you any cushion if things go sideways.
This one sentence really just says it all, doesn't it? Autodesk is the classic example of a very, very good company, but the analysis shows it's being sold at a poor price, and it comes with some baggage, the aggressive debt and those past accounting questions.
And that leaves us with this one really important question to think about. When is a great company not a great investment? As this case shows, it's when the price doesn't just fail to offer you a margin of safety, but instead asks you to pay for a perfect future, and then some.